The financial planning process is a systematic process that considers important elements of an individual's financial affairs in order to fulfill their financial goals. The financial planning process has many steps. During the course of this entire semester, we're going to investigate each of these steps. Defining your goals is step one. You need to be specific about what your goals are. Then you'll develop plans and accumulate assets or investments and strategies to achieve those goals. You'll implement those financial plans and strategies that you've developed, and you periodically need to go back and change the strategy and sometimes implement a budget to monitor and control your progress towards the goals. You can use financial statements to evaluate the results of plans and budgets and take corrective action as required. For example, you might notice that you purchased a vehicle and the cost to maintain it is expensive, and that cost to maintain it is decreasing your ability to save. So you may go back, take a look at your budget, and say, I'm going to have to sell this car. It's too expensive to maintain. It's not in line with my goal of being able to save a certain amount of my paycheck, and that in itself can be a goal. So I would like to save X% of my take-home salary. And then you'll kind of go back to, you'll look at your budget, monitor and control your progress towards those goals. So you may have to periodically address these different steps. Like, your financial goals can also change over time. So you may be redefining your goals and revising plans and strategies. Sometimes things come up in life. You could lose a job, a partner loses a job or is sick, you have a parent that's sick and you need to take time off of work and care for them. So those things can change what your goals are going to be in the long run. If your goals don't change, you just have these different personal circumstances that affect your income, and you may have to go back and address what your plans are, implement those plans, and take a look at your budget. So, what are financial goals? I want to buy a home. I want to build a college fund for my son. I want to achieve financial independence from my parents. These are all examples of financial goals. I think it's important to be a little more specific even. So I would like to buy a home in a certain amount of years in this certain location. The cost is going to probably be this. You may even want to take a look at interest rates and think about, well, what's the actual cost of owning that home? What's the cost of insuring and maintaining that home? And then you can kind of back into what you need to do planning wise to achieve that goal. Money and satisfaction are an integral part of the financial planning process. Why is this? We all have different feelings about money. And money, in an economic sense, has a few different characteristics to it. We think of money in the US as the dollar. We might think of it as the euro in Europe. And basically, it's something that is a medium of exchange, a store of value, and a unit of account. So, what do we mean by that? It means that we use it, we exchange it for goods and services. It's readily exchangeable. People accept the dollar or the euro anywhere, whereas, like, I can't take my car and buy things with it directly. I have to sell my car $4, take those dollars and buy something. The amount of dollars I have represents a store of value. Again, when we look at our assets minus our liabilities, we tend to translate all of those assets into dollars before deducting out the liability of the debt that we owe. And it is a unit of account. So the money doesn't go bad. I can review it somewhere on a ledger. And that's one of the issues we have with, we'll spend a little bit of time talking about like cryptocurrency in this course, but that's one of the issues we have with cryptocurrency is that its value fluctuates so much. So it makes it hard to be valuable in the same sense. Like, it actually can produce very positive returns, but like we've seen now where there's a significant downturn in the crypto economy, that store of value is not well maintained. It's also not always a great medium of exchange. People don't want to accept it. So it makes it kind of hard to call cryptocurrencies at this point in time money. So, money and utility. We kind of tend to think about the things that we buy as giving us a certain amount of satisfaction. And that satisfaction in economics is surrounds this like concept or theory of utility. And utility is the amount of satisfaction that I get from consuming something. I also pay for it. So there's a budget constraint, right? Like I might not get that much satisfaction from buying a bagel at the bagel shop, but it doesn't cost that much. So my satisfaction per dollar spent could be rather high, whereas like I get a lot of satisfaction going on a vacation, but it's very expensive. And so the satisfaction per dollar spent for both of those things can sometimes be rather similar. That's why we like to think about how much satisfaction we're getting from the consumption of goods and services within the constraint of the dollars that we spend on that item because we generally have a budget constraint and there is scarcity. Our psychology, our values, our emotion, and our personality all tie into how we feel about the consumption of goods and services. So, money is an important motivator of our personal behavior. And it's important to reflect on some of these important questions. How important is money to me and why? Why is it important or is it not important? What types of spending give me satisfaction? You can do an exercise where you sort of spend the day and spend, you're going to the grocery store, you're going to get a coffee, or you're going to your yoga class, and like, which of those items really give you satisfaction? And sort of think about why that is. And also, money, it's important to think about if you're a risk taker. This can influence the kind of careers you might choose or not choose, places you would choose to live or not choose to live, homes you would buy or not buy, and the sort of investments that you would make. Someone who's a risk taker might want to make more risky investments, and someone who is less of a risk taker would not, if even they're given the same amount of information about the two different investments. Another question that I think is interesting is, and it ties into the concept of how you feel about money and risk. Do I need large financial reserves to feel secure? Some people do and some people don't. And that definitely influences their choices and their personal behavior. So, all of these questions are important to reflect upon when creating your financial goals and developing plans and implementing them. You should be really specific with your financial goals. So, we sort of talked about this when we're talking about like, oh, I want to buy a house, right? Like where? How much is it going to cost? What sort of maintenance will that sort of home require? What is the interest rate going to be on the mortgage? Do you have enough for a down payment? Things like that. Be really specific. I want to save 10% of my take home pay every single month. Like that is a specific sort of goal. And they need to be realistic. And I don't want to like squash anybody's like hopes and dreams here either. So like I really believe in setting big goals for yourself. But at the same time, like think about where you're at right now. Like what can you really do? Like it might not be realistic to say I'm going to save 25% of my take home pay, but it may be realistic to say, I'm doing this right now. It's going to influence my future income in my job or my business, and I'm going to be able to save 25% of my take home pay in a certain amount of time, right? And try to be definite about like how that's going to occur. And when I mean definite, I mean be specific and really think about the steps you're going to need to take. If you're operating within a family and it's not just you or just you and your partner, maybe it's you and your partner and children, everybody needs to sort of be on the same page or at least like part of the financial planning process in order to have consistency, right? If we have like a mom who doesn't really like spending and a dad who likes spending a lot and the kids, like some of them like spending and others are afraid to spend, you're going to have differences, but you should be able to kind of come together and try to create some financial goals for yourselves. And that way you have buy-in with all parties. Your financial goals can be short term, long term, so 6 years out or more, or intermediate term, the next 2 to 5 years. I think it's a good idea to like make a list of like, well, what are my short-term goals in the next year or so? What are my intermediate term to long-term goals? Long-term goals can be as long as 30 to 40 years. Like when I retire, I would like to have this much of income per month to spend. I've sort of thought about what's going to happen to inflation over the next 30 years, what type of income I need, like where I'm going to live, and how long I'll need that income for, and then even like what will I want to do with the assets that I have. And that's sort of like your longest term financial planning will be your estate planning. And short term could be something like cash reserves. Like, okay, I don't have a safety net around me and that makes me concerned. Like, what if I lose my job? We may or may not have a little bit of a recession coming up here. So if we do and I lose my job for 3 or 4 months, I know that when I file for unemployment, this is how much unemployment benefits I'll receive. My company will pay for my health insurance. Really think about those things and say, in addition, like I would like to have a certain amount of money set aside in an account, and that would be for if I'm unemployed for a few months or if my car breaks down. So things like that. And I really liked this little, like, you don't have to set it up like this, but I do like how they've basically put down, okay, here's their short term goals, here's their intermediate goals, and here are their long term goals. And they wrote some target dates. I like to do this too. I don't do it in such a specific way. To be honest, my long term goals are something that I'm sort of constantly evaluating. And my intermediate goals are definitely, I have a goal and I'm trying to get there. And I know how much it costs, but I haven't really ordered them. I like how they order them here. And they could be just like really simple things. I need to buy new tires, or I want to start a family, and like I wanted to. Thinking about these things, some of which don't seem like they're financial goals, but they are, because there's just so much that surrounds all of these decisions. Um, and I just think it's really important to, spend some time essentially like planning what your goals are, which even if they're not you don't think of them as financial goals, they do have financial characteristics surrounding them. Okay. And over sort of like our life, we kind of see this like this here sort of represents like we have negative income there, right? Someone's giving us income in order to get to this age. And then here we see like increasing, our income is increasing at an increasing rate, and then it's sort of like decreasing. It's still increasing, but it's increasing at a decreasing rate, is what they say. And I think this is a really interesting sort of diagram, because it sort of shows like, family formation, retirement, and sort of what would be going on in these different areas. So, we might start thinking about asset acquisition, in our 20s, and liability and insurance planning, and that we might kind of be thinking more about our savings and investment planning. Taking a look at those employee benefits that we're given, like they could go a long way. And like, what are they? There's all this stuff that you get handed by your employer, especially when you're in your early 20s, and it just doesn't seem like you'd ever need it, but you might. Tax planning, sort of as you're getting into your 30s, you may need to talk to someone who can help you think about all of the different tax strategies you can employ to reduce your taxes. And then obviously, sort of retirement and estate planning kind of spans the entire spectrum. And that's because, most Americans don't work for an employer anymore that's going to take care of their retirement. for them. They don't have a defined benefit pension plan like teachers and firefighters in the state of California do, and in a lot of states they do. But it also requires that you teach for like 30 to 35 years with those organizations, or you work for them for that long. So a lot of people are having to do their own retirement planning. Okay, I really like financial calculators. I look at one all the time. Maybe a little bit obsessively actually. And this is a really good example of like why you want to start saving if you can as early as you can. So if you start investing for retirement at the age of 40 and put only $2,000 a year in an IRA, earning 5% for 25 years, so when you reach the age of 65, you'll have $95,000. However, if you start 10 years earlier, you'll double your money. And that's not like you're saving for 25 years. So it's more than half of the total time added to, less than half of the total time added to your savings, and you're doubling your money. And basically what this is the compounding impact of interest rates on your savings or on your debt. Interest is very powerful in how it impacts your savings, and differences in interest rates will impact your savings in large ways. So if we were to take a look at like a financial calculator, and we'll talk more about this too when we spend time. There's a couple of chapters in our text where we look at savings and investment in detail, and we go through these exercises specifically, so you don't have to really know how the math works right now, but I'll just like show you an example. So basically in a financial calculator, like if we were looking at that example here, so $2,000 a year at 5% for 25 years. And we kind of calculate that. That's how we get the 95. But if we have 35 years, that's how we get 180. So I love these financial calculators. They're all over the internet, and you can pull one up, but we'll also go over these in depth in the class. And here's a good example of what happens to your savings when it's impacted by different average interest rates. So this is a 6% interest rate applied over time to $1,000 investment. So in 40 years at a rate of 6% interest, that investment will be $10,000 versus $4,000. So that extra 2% is actually quite impactful and more than doubling the rate of return. And the interest rate itself is not double, right? You notice it's not like 4%, it's not 8% versus 4%, it's 6%. And the investment is ends up being twice and a half what it would be at an interest rate that, is about 2/3 of what it is, or 1.5 times greater. So asset planning, liabilities insurance, savings and investment, tax planning, employee benefits, and retirement and estate planning. These are all things that we're going to be talking a lot about in the course. Assets are things you would like to acquire, whether it's a house or a boat or a car or some furniture. And liabilities is all of the debt you have. So any loans, education, car, credit card balances, and insurance that you will buy to protect your assets and your income and savings. We'll also be talking a lot about savings and investments. So the decisions surrounding, how you choose to allocate your savings. Tax planning looks at the different ways you earn income and how that affects your taxes and tax rates. And employee benefits, this is like those fine line item things when you sign up to work somewhere. So what sort of life, health, and disability insurance does the employer offer? Is there tuition reimbursement, pension, profit sharing, 401k plans, flexible spending? There's so many different things. And I think it's important to kind of take a look at them. Those benefits can be really impactful. For example, some employers will pay for a lot of your childcare, and that can incentivize you really to go to work versus not going to work. If you don't have childcare and your employer doesn't pay for it, going to work can often really reduce your income. And then lastly, retirement estate planning, which kind of spans this entire concept or the entire financial planning like life cycle. Okay, so there's some special planning concerns. You may need to manage two incomes. Employee benefits are what we kind of looked at on the other page. So does your employer offer a 401k plan, flexible spending accounts? Do they pay for childcare? And we always need to think about how we'll manage our finances in tough economic times. We tend to see that our recessions, so like peak to trough, is anywhere between 5 and 10 years. So if you're 25 and you live to be 100, that's between 4 and 10 recessions in your lifetime, depending on what's going on with the economy. We haven't really had a recession since it started in like 2008 and 9, and 10, 11, and 12 were still kind of rough. I don't know what the exact date was that we exited the recession, right? And then we did have a downturn during the pandemic, and now we may have another downturn. So, even in the last 23 years, there's about 3 time periods where you might get laid off, or at least your investment portfolios are going to take a hit. And we need to plan on how we're going to manage our finances during those times. And there's also different life challenges: birth of a child, marriage, divorce, illness, job loss, accidents, retirement, caring for a parent. All of these things are things that we want to, unfortunately, have to incorporate into our financial planning process. The book talks a lot about the two income family facts. I would say that a lot of times two income families are necessary. So, both adults in the household are going to need to work, or they choose to work. Sometimes that second income doesn't add as much as expected. And this has to do a lot with the fact that one or both of the partners are not able to contribute to the household and sort of the uncompensated labor that occurs in the household. So who's cooking, who's cleaning, who's running errands, who's figuring out how the taxes are getting paid, all of those things. They're generally like uncompensated labor for the person who is not working. If you choose to go to work or choose to have two people working, it is often a lot of those things need to be outsourced, and the cost to outsource them can be rather high. Childcare is not cheap. But many people have to work. Luckily, a lot of people might have family members that can help out. So I think that's one important sort of way around that situation. And then oftentimes it's important to keep that job in the long term, right? You might be in a really important part of your career, and stepping back might not be the right choice for you in order to maintain your career. On the other hand, stepping back might be the right choice for you. So everyone has to sort of take a look at, whether the two income model works for them. Okay. Do you need a professional financial planner? You may. They are an individual or a firm that has individuals working in it that helps clients establish financial goals and develop and implement financial plans. Their role is similar to that of someone like a personal trainer. They're going to kind of tell you this is what you need to do, but they can't force you to do it. Their qualifications and their track record does matter. So take that into consideration when you're hiring a financial planner. The compensation structure for a financial planner tends to be like a hybrid model, where they are compensated both based on both commissions and fee only. So commission is like every time you place a trade, and fee only would be like, we're going to develop a specific plan for you. So be mindful of like how your financial planner is compensated and what sort of motivations they have with regard to their own compensation when they are managing your assets. That's all for now, and we'll take a look at the economic environment in another video.